Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is April 4th, 2024, and we're going to discuss fear and loathing ahead of the non-farm payroll. So today we saw a major sell-off. In fact, it's the largest single bearish day that I could find, certainly in the last year and actually going back a couple of years. Is a massive range on the SPX. It was almost 120-point range. Today on the SPY, you can see that the range was 11 points. Versus this 513. And so major sell-off, and from the highs we're down about 2.5–3%. Not enough to put us into a bear market, but a major sell-off and on higher than normal volume. When we saw that sell-off in the SPY, we saw an even greater sell-off in the Qs, as we know that the Qs have been kind of propped up from the tech stocks. So we can look at the move through here. This is the QQQ, 1184. And as a percentage from the high to this low, if we go from that high shadow down to this low shadow, you can see about 3.5%. So a little bit larger pullback off of the high. A little more of a key support level as we see the gaps in the floors and support level that's created right across here. At least that's the one I'm seeing. Now, if the Qs are pulling back to a key support level, the SPY is selling off, and we see this pullback. The question is it fear? Is it aggressive repositioning? Are we running into cash? Where is the money going? And what might we expect? Well, today we are planning and prepping for non-farm payroll tomorrow. It's one of the more significant news events or econ events that we have in any given month. And we're expecting it to probably miss. We've had rising unemployment claims or weekly unemployment claims, and they've held up pretty high and been revised higher every week for the last month. So that could mean that we're going to see a miss in non-farm payroll. Additionally, we might be able to see where those sectors are, and we can talk about that more in detail tomorrow as well. But as we're looking at this, we also saw news-driven events, and Israel warning and pulling back from their embassies and evacuation orders because of an expected retaliation or response from Iran. And that caused a lot of uncertainty. So as we're looking at this, we could jump over to the VIX and say, did we see the rally in the VIX today where we could say, yes, fear is back, volatility is back? And as you can see, this is the highest close the VIX has given us, going all the way back to November of last year. And so I would say this is a more significant pullback rather than just saying, look, we dropped 1.5% today. Look, we dropped 2.5 to 3.5% from the highs. This is the highest the VIX has closed at this year, and all the way back into November. And when we saw those moves in September, October, November of last year, what did we see happen in the market? During the same time frame, September, October, November, we saw a move in the SPY from about 450 all the way down to about 400. So we saw a 10–11% drop from the highs. Are we going to see that same 10–11% drop from the highs here? Are we going to see a 52-point drop from the top peak up here, which would bring us all the way down into this 480, 470 level? That could be a major significant drop. And we can wait. We can just wait till it breaks through that key support level on the Qs. A little bit lower on the SPY, I'd say maybe 510. Now, if we're uncertain and we're seeing fear rise, it is probably the reason why I called this fear and loathing, is because when we see it driven by news and fear because of geopolitical uncertainty, the loathing is part of what I'm looking for, as well as a way to look for defensive stocks. Now, when I say defensive stocks, I'm talking about military defense stocks, because conflict usually sees money move over to some of those military type stocks. We also can look at consumer discretionary. We can look at healthcare and utilities as our normal defensive sectors, but I'm talking specifically into the military defensive. So let's start looking at a couple of those really quick. And we're going to only highlight a couple here, but let's start with NOC, Northrop Grumman. So Northrop Group, as we're looking at this pullback was before today's events. So today's events actually saw NOC hold up at a key support level. Now, I think this pullback is an opportunity, because if we go from 460 back up to 480, there's going to be an opportunity to not only make that distance 20-point move, but we could actually sell puts down here. With the higher volatility, we could actually sell puts to get into this position. If we take a look at the options on that, let's go ahead and go into there. And I will show you what I like to look at. And we're going to go into, let's just start with about a month. We're going to go 30 days, and that is that should be after their earnings, but we're going to go 30 days out. And what we're going to do is change the layout from Delta Gamma Theta Vega to custom, and we're going to add return on risk. And the return on risk number, what it will tell you is that if you get assigned on this short put, what are we getting compensated as a percentage for selling an at the money put? Right now, for 30 days, we can get 2.34% for selling a 455 put. Selling a 455 put is selling $4 lower, or being willing to buy at $4 lower than the current price, gives you an extra $4 safety net in addition to getting paid maybe $10 right through here. So we can get paid 2.5% roughly on being willing to buy it down here. Now, if we get assigned, then we will look for it to bounce back up and go from 460 up to about 480. They do have a dividend as well, about 1.63%. And I like this one for the 2.5% return on investment that could turn into a directional trade that might be able to pay you an additional 5% to get back up to this high, in addition to the dividend yield and then possibly later covered calls. Lockheed Martin is giving us a better setup because we had a gap up close higher. So this is interesting to me as well because it seemed to have gapped up and moved higher ahead of the warnings from Israel. So we saw the major move up, gap up, close higher. This is a candlestick pattern that I would say is a bullish candlestick pattern. It's not even a piercing line. It is a full reversal, gap up, close higher, higher highs at lower lows, but a higher close. And Lockheed Martin looks to be heading back up to 465, if not continuing higher. The short put doesn't pay us nearly as much as what we just saw on Northrop, but I like this as just a directional trade. If we look at the dividend's about the same, a little bit higher actually, about 2.78%. And so we could buy in here, collect a dividend, and anytime we see a couple of bearish days, then we can sell calls against this one as well. But I do like the bullish setup on Lockheed Martin. Normally, I would look at Boeing as an aerospace and defense contractor as well. I'm not that interested in Boeing right now. I would also look at Textron. Textron is a company that owns a number of things, including Bell helicopters. So from a helicopter standpoint, we could see Textron be a potential buy. The chart's not as good as far as the move today. It's just a gap up in a very flat trading day. It's been amazing trends. I just don't think we have the same kind of upside as we did in the others as far as Textron is concerned. I do like the stock still, but I just don't think today is the timing for it is right. Let's go look at LHX. And L3 or LHX gave a great reversal pattern off support already. It already bounced, it already climbed higher. It does feel like that was a big move, and so we might be able to get a better pullback near 208 and get to buy into it a little bit cheaper price. If you look at the puts, we don't have month-to-month puts, and the payments aren't really enough to justify selling puts to get into this trade. So I would just simply wait for a pullback and look to buy near 208. The implied volatility isn't too high. You could probably even buy a long call after it pulls back to 208 on L3. Two more that we're going to look at, and that is Joby. Joby is highly discounted. Joby Aviations is highly discounted. It is a very cheap stock. I don't think this is one I would normally look at in conjunction with trading from a option standpoint, but it is so discounted, it looks pretty decent. It's not a defense stock like a military defense stock. It is an aviation stock, obviously, and it is more of one tied and associated with consumers, but it has a lot of technology that's kind of about the vertical takeoff and could be something that I think could have application, and we'll see where this one goes. Just a cheap stock to maybe consider. So the last one is DFEN, which is the Direction Aerospace Defense Contractors, and you can see it looks very similar to some of the other charts we just looked at. And as we're looking at these higher highs, higher lows, this pullback, the gap up and pullback today, still could be an opportunity to lean into this one from an investing standpoint. And by selling a put out 43 days at the current price, we're at 25.60, so 60 cents lower, we're getting 5%. So being willing to buy it down here at 25 for the next month, month and a half, at a key support level, or the support level that we just put in a couple of days ago, you could get 5% for 43 days. I would simply call that a 3.5% return for a month, which would equate to 40% per year if you could get that every single month. But if you want to reduce the exposure from having it all in one stock, DFEN is the stock you may want to consider. As we pointed out already, tomorrow is non-farm payroll. I do expect non-farm payroll to be less stellar than what we thought, and it may give some sentiment that we're going to have a little bit of a rally because, hey, they were going to price back in those 3 rate cuts this year. But I'm going to look for consumer staples for a bounce, but I'm going to look for bearishness in consumer discretionary because I do think it's going to be a sign of a further slowing economy and employment situation. So if we're looking at XLY, we are right back to, and I would argue through, because this is a lower close, that short-term support. If you need a little bit more of a push, we just need to get through about 177. Rather than just simply shorting consumer discretionary, I'm going to look at very specific consumer discretionary, and that is going to be starting out with Whirlpool. Whirlpool is one that is going to be the larger ticket items that we're going to try to avoid buying if we are getting low on cash or our job is uncertain. And I like this movement. This is a piercing line after an attempted bounce. So I do like Whirlpool short here, whether you sell a call vertical up at 120 with the higher implied volatility or simply take a long put position or a short stock position. Another one that I think is coiled up in a real opportunity over multiple days, if not multiple months and even quarters, is Garmin. Garmin has been driven higher and higher and higher and higher. It has reached this peak. It has created what I would consider a double top pattern. It is not a needed item. Garmin technology is not a needed item by consumers, and today's chart seems to have confirmed this is too high, and we're likely to come back down into maybe 132, 133. The double top is already formed, and that double top was looking for $4 move. That $4 move would take you down to 141. And a move through 141 could take this candle out, and again, I would be looking all the way down to 132. So Garmin could be another one for trading short verticals or simply taking a directional trade. Not very high implied volatility yet, so you could take a directional trade or an in-out spread or a long put. The last one that we will look at is MHK. So bullish on the defensive sectors, bearish on consumer discretionary and specific to the durable goods type consumer discretionary. Mohawk gapped up, closed down, and engulfed all this price action. I would argue as well that it created kind of an ugly, choppy looking head and shoulders pattern that said we should go from 130 down to 125, which would bring you down to 120. Today's candle alone was a 650 move, and we are probably going to finish that out near 115. And so I'm looking for this to continue to go lower. If we look at the options on Mohawk, we could sell the 130, which would require a reversal of all of today's price action and a fill of the gap. And if we sold a 130 call versus the 135 call, we'd have a 132 credit for a $5 wide spread. This is a good payment, a good premium. You're getting about 30 to 40% return on risk with a pretty high probability and a very difficult time to reverse out that candle. So I like that one as a bearish position as well. So looking for bullish or collect premium on the military defense type stocks, looking to be bearish ahead of non-farm payroll on the consumer discretionary durable goods. That's going to do it for me today. We will talk again tomorrow after non-farm payroll. Have a great night, and we'll see you next week.